Oh, hello. Welcome to my home study, or my beautiful tax write-off. Or is it? One is Nuck, and this is one's Nuck report. Thanks to Matt Dixon over at Workbox Safety for this request. You can find out what Matt does on Facebook. Look up Workbox Safety. Matt's query was about home office expenses and the capital gains tax implications. The first question that needs to be asked is whether home is a place of business. This can be whether you're a sole trader or a partnership and home is a genuine place of business, or it can also occur if you're an employee, even an employee of your own trust or company, and home is your sole base of operations. For sole traders and partnerships, part of your home will be a place of business depending on a few factors. The area is clearly identifiable as a place of use. The area is not readily adaptable back to private use. The area is used almost exclusively for carrying on a business, and the area is used for visits by clients or other suppliers. For employees and or people who operate their business through a company or trust, the test for whether home is a place of business will be very similar to those for a sole trader or a partnership I just mentioned. So from this, obviously sitting in the kitchen table doing some invoicing isn't a place of business. We'd argue that in most cases, a separate room in the house used just as an office probably isn't a place of business either. These things tend to get used privately quite a lot for storing items, kids to play in, etc. as well. If home is a place of business, then this allows you to claim an apportioned percentage of home occupancy and ownership costs. The sort of costs I'm talking about are showing up on your screen right now. However, if home is a place of business, then you most likely use the ability to claim the main residence exemption on your property, or at least part of the property. However, on the flip side, if home is a place of business, you will most likely lose the ability to claim the main residence exemption on a portion of your house. This doesn't apply if you rent. So although home as a place of business opens up a number of deductions in the short term, it can open up a potential liability in the long term. If home isn't a place of business, merely an office or a study, you're limited to only claiming the running costs of your property apportioned for the usage. However, you won't have a long-term liability for capital gains tax. The sort of expenses I'm talking about are now showing on your screen. The ATO also allows a set rate of 45 cents per hour worked as a substitute in this circumstance. But the most important message here is that you don't have a choice. If home is a place of business, then it opens up the potential for a CGT liability, regardless of whether or not you choose to claim the ownership deductions. You really should talk to your own tax advisor about this one, because there are a lot of factors to consider if home is a place of business. And even if it is a place of business, there are some things that can potentially be done to reduce your capital gains tax liability down the track. Thanks for joining me today. If you've got any other topics you want covered, stick them down in the comments there. I'm Nuck, and this is the Nuck Report.